Welcome back to the Watch List. I'm Nicole Petalides. We're watching oil hurricane season. In fact, Hurricane Beryl's landfall in Texas is being blamed for billions of dollars in damage, but Texas's oil infrastructure actually escaped with a little, serious damage. But the big picture here is this was a Category 5 hurricane. We have not seen a hurricane like this one, a Cat 5, since 2005, the same year as Katrina. They're starting earlier. They are huge and really bring a lot of risk. What happens to oil overall, too? Carley Garner's with us, senior commodity strategist broker at Carley Trading. Tyler Richey's with us, co-editor of the Sevens Report Research. Now, Carley, I know you've been doing some calculating. This was really scary. I know it was blowing through Curacao and the Caribbean islands, and it came in fast, hard, and it's early in the season. What do you make of this at this point with your calculations?
Well, I mean, as we all know, the oil market is basically the poster child of buy the rumor, sell the fact. The market generally prices in a risk premium and then pulls it back, because more often than not, our expectations of the damage are larger than the actual damage itself. And so I think that's what we've been seeing the last couple of days. But there's a reason that seasonality is bullish this time of year. Part of it is hurricane season. And according to my charts, what we've seen the last few days was just normal back and fill. We basically broke out on June 27th. We've come back and tested that daily downtrend line and successfully tested it. We got some buyers coming in. This tells me as long as the $80 area holds, which I believe it will, we're probably going to make our way up into the 87 range. There's going to be a little technical resistance there, but I actually believe we're probably going to break through. I think fundamentals, hurricane season, in addition to seasonality and fundamentals, are positive enough to get us above 87 and continue into the 90s.
Right, so watching the up end of oil and where it could head. Tyler, what are some of your thoughts? We've also gotten in the EIA report showing crude inventories, in fact, falling for a second straight week. Beryl, in the meantime, folks, has gone from a Cat 5 to, I think, a Cat 1 and maybe even lower at this point. But that's not, it's the first. I don't think it's the last of the season. Tyler?
Yeah, of course, there's definitely... Totally agree with what Carley said there. The buy the rumor, sell the news into the end of last week and the beginning of this week. But I think that it's a little bit of a tale of two time frames when it comes to oil right now, as far as the fundamental outlook goes. And that is due to recession concerns, kind of keeping a lid on rallies so far in 2024. I agree with that 84 resistance level. We pushed up against that last week before pulling back early this week. But the long-term issue being a recession, but the near term, we've got very strong evidence of consumer demand in the high frequency data released by the EIA, specifically the gasoline supply being over 9 million barrels a day and at a 52-week high as of today. Earlier today when that was released. But that strong consumer demand is what I think is really driving the price strength recently.
And with concerns about a recession or a slowdown, you have the demand, you have the summer driving season, you have the risk of hurricanes. Those are the things that push oil higher. But recession means oil lower. When you look at this at Carley Trading and you're combing through the numbers, you still see the higher end, right? I mean, you're not looking to that $60 level, are you?
Eventually, yes, but in the short run, no. To Tyler's point, the stock market and crude oil have had a positive correlation of about 80% over the last 30 days. So as long as the stock market keeps pressing higher, which I am 100% on board with the idea that it's overstretched, but it continues to stretch higher, and that's pulling crude along with it, and it probably will continue to do so until something changes. But I'd like to point out that from a political standpoint, the U.S. shale producers have been basically riding the coattails of really great technology. Like, we're producing more oil than we ever have. We're the top producer in the world, and we're doing it with fewer rigs. We're at a 2 to 3 year low in rig count. But we can only squeeze so much out of the current infrastructure. And at this point, oil producers are basically at a lame duck session. We don't know what the election's going to bring. And I think we can all agree that both of the primary names on the ballot are at two polar opposites of the energy debate. So there's really not going to be any spending or effort to squeeze anything out of the existing infrastructure until we get beyond that. And I think that continues to press supplies lower and prices higher.
Yeah. Tyler, I'll give you a final thought here. I know you are concerned about long-term risk.
Definitely, concerned about the long-term risk and looking for downside over the next 2 to 3 quarters. Although I will say I agree with the near-term upside case, and for the traders out there that are looking to do multi-days or multi-weeks, the 21-day moving averages of in crude oil has been a very important technical read this year. So as it passes above and below, it's marked trend changes, and it actually just bounced off of it today, or overnight rather, before recovering back. So that'll be a key supporting factor for the continued rally here.
Yeah, thank you for that. Tyler Richey, Carley Garner, thank you.